Hey everyone, welcome back to the Success Blueprint, your source for strategic insights that help you navigate work, life, and finance with confidence. Today we're talking about something that impacts every investor, professional, and business leader: the growing economic uncertainty and how policy decisions are shaping real yields and investment opportunities. Let's break it down into what's happening, why it matters, and how you can think strategically about the road ahead. In this section, we delve into the economic uncertainty and the policy decisions that are driving it. Economic landscapes are shifting, and with them, the rules of engagement for investors and businesses alike. Understanding these dynamics is crucial for making informed decisions. One of the biggest red flags right now? US consumer sentiment has plummeted, hitting the second lowest level on record. And this isn't just one survey, it's consistent across multiple data sources. What does that mean? When consumers lose confidence, they slow down spending. That spending slowdown can drag down economic growth, especially if a shock hits, like a geopolitical event or policy misstep. While a full-blown recession isn't a certainty, the vulnerability is real. Economists are now giving a 50% probability to a recession within the next year, so it's not off the table. What makes this more complex is the gap between soft data like sentiment surveys and hard data like inflation and employment numbers. So far, the hard data looks stable, but expectations are that by Q3 or Q4, those numbers may begin to soften. Let's talk about the key policy forces stirring the pot. Tariffs are back in focus. A majority of consumers and businesses are now citing tariffs as a top concern. Why? Tariffs are inflationary. Even if they aren't extreme, they add pricing pressure. Companies are entering a trial and error phase, testing how much they can pass on costs to consumers, which adds more uncertainty. The Federal Reserve's tightrope walk is another major factor. With inflation still sticky, the Fed is under pressure. They may wait until September to cut rates, if at all. Markets are on edge. The Fed is balancing the risk of unanchored inflation expectations with the need to avoid stifling growth. Ballooning fiscal deficits are also in the spotlight. The US fiscal deficit remains high, and that matters. High deficits mean more government borrowing, which keeps long-term yields elevated. The market isn't just reacting to the size of the deficit, but the lack of fiscal discipline in Washington. Together, these policy dynamics are creating an environment of persistent uncertainty, one where rate cuts are delayed, inflation concerns persist, and confidence is fragile. Let's delve into real yields and fixed income, a crucial area for investors seeking stability and returns. Real yields, which are adjusted for inflation, provide a clearer picture of the true earning potential of fixed income investments. As inflation remains a pressing concern, understanding the dynamics of real yields becomes even more important. Fixed income investments like bonds are sensitive to changes in interest rates and inflation expectations. When real yields rise, it often signals higher borrowing costs and can lead to shifts in investment strategies. Investors need to stay attuned to these changes to navigate the complex landscape of fixed income effectively. Now let's talk about yields, a key indicator that reflects market sentiment and guides investment decisions. 30-year Treasury yields are nearing 5%, and the 10-year is around 4.5%. These elevated yields are being driven not just by inflation fears, but also by fiscal stress and market anxiety. Some expect modest downward pressure later this year, but only if the Fed cuts rates and sentiment stabilizes. So what does that mean for investors? Here's the good news. Despite all this uncertainty, fixed income has become an attractive investment option again. Why? Yields on diversified fixed income portfolios are now in the 6 to 8% range, depending on credit risk. Compared to equities, this offers a smoother ride, especially in a market where volatility is likely to stick around. Corporate debt markets have seen a quick rebound in risk appetite after brief widening in spreads. Even high-yield or so-called junk bonds are drawing strong demand. Investors are coming back into the market encouraged by attractive yields and strong corporate fundamentals. Many companies entered this period from a position of strength. In some cases, high-yield credit metrics are now overlapping with investment-grade levels, supporting a move down in quality if you're strategic. But here's the caution. Market timing is tricky. Volatility snaps back fast. So the smart play: build a position, stay diversified, and manage your risk. Section: Strategic Takeaways and Conclusion. If you're a professional investor or just trying to make smart financial decisions, here's how to navigate the current climate. Stay informed on macro trends. Sentiment often shifts before the hard data does. Diversify into fixed income, especially if you're looking for income with less volatility. Watch for rate policy changes in late summer. Those could be key turning points. Be cautious with risk assets. Snapbacks are fast, but damage from uncertainty is real. So while the headlines are noisy and the economic signals feel mixed, the underlying trends are pointing toward cautious optimism for fixed income and continued vigilance in equities. The key is to have a strategy and stick with it. If you found this breakdown helpful, give the video a like, subscribe for more strategic content, and share this with someone who's watching the markets closely. What's your take on the current economy? Let me know in the comments below. Until next time, stay focused, stay strategic, and keep building your success blueprint.